Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwi Bank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. Kia ora koutou and welcome to another week, another episode of Markets, Mystics and Mayhem. This week we're going to talk about markets. We're going to delve into what's happening in financial markets around the world and bring it back to New Zealand. I think a growing theme out there, or the growing realisation that tariffs are going to have an impact on demand. Global growth is going to be a little weaker than people had expected. That's starting to play out and it's starting to be factored in to financial markets. We've seen equity markets come back just a little bit. They're still quite high, doing well. We've seen interest rate markets come back and we've seen currencies adjust. There's a lot going on, but basically things are playing out as we have been suggesting on this podcast for some time, and that's that central banks need to do more rate cuts. So let's get stuck into it. Markets have moved a bit in the last week. Seems to be data driven.
It is, and I have to say it's been. Before last week, it was actually quite boring watching markets because, you know, the Kiwi dollar was trading sideways. Kiwi rates were kind of stuck within a range. So it's been, I hate to say it, quite boring. But then last week, because of the data, payrolls in the US came in really weak, and we just saw some big moves. And as you're right in saying that, there is this theme or this realization that tariffs will have an impact, because the Bank of Canada, they met last week and they paused. They didn't do anything to the rates, but they did seem inclined to reduce rates, in the next meeting, because they're saying that, the inflation impacts of the tariffs, so long as they're well contained, the uncertainty that's currently the play right now, that'll lead to a negative demand shock and it would require lower interest rates. So we are seeing moves towards lower interest rates.
Yeah, and you got the Bank of Canada, you got the ECB, Bank of England, saying similar things, and then you had that payrolls report, which was an absolute shocker.
Yeah.
It came in well below consensus, but more importantly, the downward revisions to the prior months.
Huge.
It just took 100,000 plus out of a particular month.
Yeah. Try 258,000 was how much
over the 2 months.
Yeah.
That's a lot, eh?
Yeah, so just 73,000 jobs were added in the month of July. The downward revisions meant that in the month of June, just 14,000 jobs were added, down from 147. Of course, you had 147,000. Of course, you had President Trump come out and say that the data is fake news and it's rigged, and he's calling for the head of the Stats Bureau to be fired in classic apprentice fashion.
He's still on TV.
But yes, so it was really quite a big disappointment. And it just shows that those cracks in the labor market, in the US labor market, that were starting to show at the beginning of the year are really starting to widen. And, it's not quite in a crisis level yet. Unemployment's at 4.2%. But we are, this is just kind of the slowdown that many were expecting for the US labor market.
And the market's now got a full rate cut by September, right?
Yeah, pretty much 88% priced in.
Yeah, it's
September.
A big move from where it was.
Yeah, it's a big move from the Fed, because they also met last week. And Powell, there's kind of two aspects to it. You had the statement, which arguably was quite dovish. They, the officials kind of downgraded their view on the US economy, saying that growth had moderated in the first half of the year. But then Powell kind of came out a bit hawkish in the press conference and kind of pushed back against market pricing. So after that meeting, market pricing was had reduced chances of a rate cut. The payrolls number came out really weak, and we saw a rate cut being fully priced in again for September. So it's been quite up and down, to be honest.
Yeah, and I don't think Trump's helping
No.
At all, because he's putting so much pressure on the Fed and Powell in particular to cut. And as an independent central bank, your natural reaction is to push back, right? I think they're just going to have to swallow it and deliver the cut, right? there's not really a lot else you can do really with an economy like that. So if we've got our largest economy cutting, you've got the Bank of Canada coming back in, Europe, I think more to do. What about the Aussies? I mean, their inflation report was pretty weak as well.
Yeah, another key data point. It came in 2.1% year on year over the June quarter. The RBA have a target range of 2 to 3%, so that's very much at the bottom of their target range. 2 to 3%. And then trimmed mean, which is you remove the volatility in some price items, that came down to 2.7%, so the lowest since December 2021. Again, it's just a point in favor of cutting interest rates. So they had a labour market report not too long ago that was quite weak, below expectation. This is just another one pointing to rate cuts from the RBA. They decided to pause the last time. I think this is really opening the door for a rate cut.
Yeah. We've had a few pauses around, haven't we?
Yeah.
And then the realisation, well, actually, we need to keep cutting.
Yeah.
And I think we can bring that home and give the same message to the RBNZ, right? You've paused, but that was the wrong thing to do. You should have kept cutting. And financial markets are reacting to that. So it's been interesting. Equity markets have been doing quite well, and I think it's just recently that they've cracked again. Earnings so-so, but they've come off their record-breaking highs.
And to have so-so earnings in a pretty volatile world, and to have it in a world where tariffs is really the main thing here, which could disrupt production around the world, to have a pretty okay earnings season, it just speaks to pretty optimistic outlook for financial markets and economies.
Yeah, I mean, there's been some interesting things, right? There's been some front-loading of activity in anticipation of tariffs, and then the kind of the unwind of that, and it's been very turbulent and choppy, as you say. But I think the message for me, at least, is that the realization is, sure, we've got an inflation spike very near term, particularly in the United States, but demand, will counter that over time. So we're going to go through and we're going to see like a GST type tax spike that we've had here in New Zealand in the past, but it'll be unwound like almost immediately, and we'll be tracking, I think, below 2% this year. Well, you think below 2% next year, and I agree.
We think.
Oh, that's right. It's we. Yeah, your forecasts.
Yeah, for everyone. But I think you're right, because the tariff rates, the new tariff rates, have been significantly reduced from what they were set on Liberation Day. So we had that August 1 deadline, and we had a flurry of trade and tariff and rates announced last week. And you've kind of got two groups of countries. You've got countries that have a trade deficit with the US. They face a minimum of a 10% tariff. And then countries with a trade surplus with the US, they face a minimum tariff of 15%. The thing here is that Australia fits with the first group, so they get a 10% at least, and then we are with the 15%, which was quite interesting to see that headline come through, that we had a 15% tariff placed on us. I think there's meant to be some discussion between our nations about potentially reducing that, but now the playing field isn't quite level between our direct competitor.
Yeah, which is unfortunate. It's just the fact that we're a rounding error to the United States. We're not the first country that they need to deal with. And like you say, we've gone from 10 to 15, which on margins and whatever profit we're getting exporting to the United States, it just takes that little bit more. And like you say, those Aussies, again, we're not running massive surplus with the States, though, are we? So, there might be a little bit of room for negotiation there. But I've been running around the country, so have you, and, talking to exporters, and they are telling me that, hey, look, of all the places we send stuff, like the United States is one of the most lucrative. It's where we get, really good bang for buck and decent prices. So when I was talking about a 10% tariff, they weren't concerned. I imagine a 15% is harder to swallow, but it's not going to stop that trade, I don't think. And one thing that's been helpful is that over the last week, the Kiwi has dropped from 60 to 59. Now, that doesn't sound like a lot, but every cent counts, literally. And if we fall into a sort of a 57, 58 type range, then I don't think those tariffs anywhere near as bad.
Yeah. So do you think that those US importers will just be able to absorb that extra lift in rates?
I think so, because what are we exporting? We're exporting meat, right? Going to burgers. Americans like burgers.
Yeah, they do.
And they like red meat, and we are a high quality product going to, I would argue, a higher income consumer in the States. So I do think, they can wear that. We send a lot of wine as well, which is to your point about competition against Australia. So a $20 bottle of wine, goes to $22 if you're Australian, and it just creeps that little bit higher.
Surely our wine's better though.
Oh, it is.
Yeah, okay.
Unless it's Shiraz or whatever they love over there. But yeah, again, potentially a higher end product. So I think our direct trade with the United States will be okay. I hope the currency does its job in alleviating some of that for both sides. And away we go. But to our main point, it's that, the direct trade with the United States is one thing, but it's all the other impact on every other country. And we've had some good news on the tariffs. Yeah. But I don't think, global growth is going to be what it was.
No, it doesn't seem like those downside scenarios that we were kind of playing out at the beginning of the year around that April Liberation Day time. Thankfully, that doesn't look like it's going to be playing out, which is good news. It's still, tariffs are still higher than where they were pre-Liberation Day. So it's still going to see, global growth slow down, just not to the extent that we're kind of like nightmarish levels that we were expecting. But yeah, I guess it is something that we've been saying, that the direct impact is one thing, the indirect is another, and arguably that's the more that has more concern for the New Zealand economy in terms of the outlook. And on that, some of our trading partners, specifically those in emerging Asia, their tariff rates were significantly reduced. So places like Vietnam, Cambodia had a tariff rate of around 50% in April. That's been reduced to something 10 to 20%. So that's quite a big move lower for those rates. So it should see much better outcomes.
Yeah. And we all focus on the short-term stuff. So we're all saying we're going from, 50 to 10. Isn't that nice? Yeah, but 10's also a lot higher than what it was last year.
Yeah. So
you got to sort of think, well, it's still going to have an impact on growth. It's just nowhere near the downside scenarios that we were worried about, right?
Yeah, exactly. There is still this negative demand shock that will be created by these tariffs, which again goes back to our very first point of you need lower interest rates to kind of counter that demand shock.
Yeah, and it's a deflationary shock. So we also need to say that tradables component that's just spiked in the New Zealand CPI basket, it's going to drop and potentially become deflationary into next year.
Yeah, just as quickly as we've seen commodity prices rise because global demand's been strong. Global demand will be weak with these tariffs, and you could see those commodity prices, meat and dairy specifically, kind of reverse course, and that is, as you say, deflationary for us.
Yeah. So what have rates markets done? I was taking a look, and we've seen some pretty big moves in the United States. Like we had a 2-year bond rate of around 4%. Now we're at 3.67. We had a 10-year rate of around 4.40, 4.50. We're now at 4.20. So there's a few things that I would like to highlight there. One, we're factoring in more Fed rate cuts. Bang, obvious. And two, we are not seeing a dumping of US dollars. Again, the US Treasury rate has rallied, so that means people have bought it and they've lowered the interest rate on the 10-year down to 4.20. Now, there were a lot of people panicking that assets, particularly US assets, would be dumped and you would have a 10-year at 5% or higher, which makes it very hard for the US government to fund itself. So it hasn't happened again. So I find that interesting. But then bringing it home, we've had similar moves in Australia and similar moves in New Zealand. Bringing that home, our 2-year rate is the wholesale swap rate, which is at 3.08, and we use that to price our mortgages, our mortgage rates, and our business lending rates, and it's fallen. Right, it was at 3.30, now we're at 3.08. It was at 3.17 just a couple of days ago, so it's been quite a decent move. Again, factoring in more RBNZ rate cuts, right? It's been what we call a bull steepening for rates people. We love, bulls and bears and that sort of stuff. And a bull steepening means people have been buying bonds, lowering interest rates, and they've been piling into the front end, expecting cuts.
Yeah. So actually, it's maybe good. The bull steepening, you've got long end rates doing something different to those short end rates, right?
Yeah, potentially not moving as much in a bull steepening because the short end's moving more than the long end. The whole lot can be driving down, but the front end's moving more.
Yeah.
And then you can have like a bear flattening where the short end rates are moving up higher than the long end rates. We will see that hopefully in a year's time when the Reserve Bank has finished rate cuts, and hopefully in a year's time we start talking about getting out of stimulus territory and hiking again. So that's for this time next year, but right now we need more rate cuts. Yeah,
we do. I mean, it follows from that inflation report we had a couple of weeks ago, just showing that there is no kind of concern around this recent lift in inflation. It doesn't look like it'll stick around too much for the reasons we've just discussed. And also just domestic inflation is quite weak. It's just continuing to drop because domestic demand is quite weak. So yeah, it makes total sense. I mean, we've been calling for more rate cuts for a while now, but you need that to not only guarantee a recovery, but also make it more broad based and more of like a stronger recovery going into next year.
Yeah. And we should probably talk specifics. I mean, what is priced in for the RBNZ and the wholesale rates?
I have not looked the Oyster chart this morning.
I know.
Yeah, let me ask someone who knows.
So it has moved, right? We had, the market kind of around 285, 290 as an endpoint. So cutting to 3 and then flirting with the idea of going down to 275. We have moved all the way down to 275 now. So the market is factoring in 2 more rate cuts from the RBNZ. That's good. That's helpful. But we're like, we'd like just one more if we could. If we could get just one more, provide just a bit of stimulus, I think that'll help accelerate us out of this and sort of kick us into 2026 on a much better footing. So we still think wholesale markets have room to move, because if they're at 275 and we're saying 250, well, there's 25 basis points, in that very short end that can rally. And that 2-year rate that I said was at 3.08, will be below 3. It'll be around 290 or lower if we get to 2.5.
Yeah. Yeah, I guess, and that just depends on a couple of data points that are coming out soon, and we have the expectation that it'll be weaker. Labour market being one of them should be printing quite weak, just because we've seen from surveys and other data that there's just no hiring momentum, no hiring appetite right now because our economy is just so weak. There's no reason to go out and expand headcount and all that. So there is room for that 2-year swap to fall a little bit lower.
Yeah. And then relative to other countries, Kiwi's obviously weakened against the big dollar, as we've said. It's gone from 60 to 59. What about that Aussie?
Aussie, I could probably tell you what it was today as well what it was like a couple of weeks ago.
Yeah.
It just has not moved. It's kind of been trading I think we were saying it's been trading in a 5-cent range for the last decade. So that tells you how exciting that cross has been. But, you've got the RBA coming in, starting to cut. They've got probably a little bit more because inflation's really dropped there. It's just a timing thing as to when we'll see a bit more movement in that Kiwi Aussie cross.
Yeah.
Maybe we need to see the RBA actually come in and deliver that rate cut because, markets have been pricing it in. They priced in the last time the RBA met and it didn't happen.
Yeah,
so you kind of need to see the RBA act on that to maybe see some bigger moves in that cross.
Yeah. No, it has been a bit frustrating. I have some Australian dollars that I'm bringing home, and I'm converting them into Kiwi dollars, obviously. So on that cross, I am taking the bet. I'm waiting. I'm not bringing my money back just yet. I'm waiting for MJ's forecast on the labour market to come true.
Oh, no. I mean, I guess our forecast.
It's ours now.
Our forecast is, for the unemployment rate to continue climbing a little bit more, potentially hitting about 5.3%. But it really rests on, I think the details. The labour market's quite interesting because you've got this headline rate unemployment rate, but then there's so many things that go into it. Are people staying? Are they leaving? And it can really sway the move. But regardless of where that unemployment rate lands, our expectation is that it's a soft labour market. People are either leaving because there's no jobs, or they're staying, deciding to stick it up, but there's still no jobs available. So their unemployment rate will be, regardless of where it lands, it's still quite a weak labour market.
Yeah, absolutely. So, in saying that, we should see, the Aussie strengthen against the Kiwi this week. And if that happens, great. We'll both be back on Monday. If it doesn't happen, well, maybe only one of us will be back.
I'm going to be replaced. Oh, no.
Never. Okay,
I think that's it for us this week. As we learned, it's all just about the data these days, watching it unfold, what it's telling us, and it's telling us that we need lower interest rates. It could also tell us if one of us is going to be here next week or not. So we'll be back next week. At least one of us will be. And please like, subscribe, and share this around.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwi Bank.